Okay, good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets webinar, where every day we take a pause from the Middle East morning to reflect on where markets are opening in Asia halfway through their day and where they're likely to go into the Middle East and European trading day. We've got some stalwarts from Singapore this morning, and we welcome them back to the table. Kevin, let's kick off with you. Kevin Wright, lead analyst at APAC from Kpler. Where you're seeing the markets move this week. Kevin, oil prices opening in Asia a little bit again, kind of locked in a coma, as I'd call it. What's your view?
Excuse me. Good morning, Sean. Good morning, everyone. Yeah, as you say, locked in a coma. We've been in this sort of range for the last few weeks. Obviously, we're continuously bombarded and overwhelmed, if you like, by COVID news, and there's more bearish COVID news overnight. So I actually think that Brent going sort of slightly sideways, I think it's off a couple of cents on the day, is probably relatively positive in terms of outcome for the day so far. I mean, you know, the focus certainly seems within the commodity space to have shifted to gold. I think, you know, if you look at the mainstream media over the weekend, it was all about the 10% or so move that we've seen in the last few months. It was all about targeting $2,000 an ounce, et cetera, et cetera. So perhaps the cross commodity money is more focused on gold than it is on crude at the moment.
Where do you think the weak dollar plays into the equation? Obviously, we were talking about it last week. It's continuing to be a part of the narrative.
Yeah, and it's an interesting consideration for anyone who isn't themselves sort of denominated in the US dollar. So you could have a great run on a gold investment, but because the dollar starts to weaken, you may be denominated in euros or Sing dollars or in pounds or whatever, and you don't feel the benefit. So it sort of, it deflates some of that run, if you know what I mean, from a personal investment perspective.
Vanda Nahari, founder and CEO of Vanda Insights. What's the outlook from Singapore this morning, Vanda? China still seems to be in a relatively positive place.
Hi, good afternoon, good morning, everyone, Sean, and thanks for having me back on your show. I've been looking at huge amounts of volatility through the Singapore morning and afternoon now. Of course, as you mentioned, US dollar is very much in the play, so is gold. We'll talk about China, of course, but I think the market's getting quite nervous and perhaps engaging in some speculation with regard to what the Fed may or may not do over the next 2 days. And of course, there's the US stimulus package as well. And just, I was actually, my screen had just captivated me just before we started the show. Somebody took a huge profit in gold, like there's a sharp dive in gold. There was a rise in US dollars, and we saw crude moving almost in lockstep inversely to US dollars. So suddenly we saw crude going into the red after starting the morning pretty much in the green. I think China is very much in the news because of the virus. So we know Xinjiang, the Uyghur Autonomous Region, has unfortunately had an outbreak. And I was reading today, outbreaks are being reported in other parts of China as well. So very, very far away from Xinjiang. So clearly separate outbreaks in the northeast and in the southern Fujian province as well. And of course, we know China is not alone. Some other countries which had managed to get it in control are seeing flare-ups again. We have Australia, Hong Kong, Japan, and of course Spain, not to forget, in Europe. So it's very much
certainly
on the minds.
When you see a headline like the one we have on number 6 on the digest, China wants to test all 6 million residents of the city. It's quite a phenomenal sort of declaration, but also a rather impressive capacity. Their ability to keep on top of this continues to surprise, I think.
Absolutely. I think this is their winning strategy, if you will. You might recall quite a worrisome flare-up in Beijing a few weeks ago, and that's how they controlled it. That was related to a wet market. They shut down the wet market immediately. They locked down the affected parts of the city. And that seems to be the way for a lot of countries to go. Basically, governments are doing everything they can to avert a blanket lockdowns, but then quick response, mass testing. And as you say, certainly China has developed the capabilities of mass testing. I think it's very much counting on that to prevent a second wave.
You wonder if it's a bit like trying to stop water going down a hill. James McCallum, Executive Chairman of Exergy and Professor of Energy at Strathclyde University. James, good morning. I'm struggling whether to pitch you the Barbados offers remote workers 12-month visa story, or the Republicans are divided on the next stimulus package. Let's go with the Americans. I think it's this sort of surprise story of the week to me that the US government, whether it's Republican, Democrat, etc., are struggling to put together a stimulus package in an election year when really they've nothing to lose by printing more money.
Yeah, good morning, everybody. I think the American story is against a landscape of multiple complexity at the present moment in time. If you take a look at what's going on in Portland, Trump is having to fight a position on several fronts, and I think the Democrats can see that. I think it's good that there is at least some kind of volatility. I think Vandana would refer to it as. I think it's good that he's having to fight his corner. I think ultimately he will win the stimulus package because the United States needs it. He needs it. Going into the election. So I think it's merely a matter of time before he gets that across the line. The big question, of course, is ultimately just how successful the popular uprising will be that's going on in Portland, whether that can pour out from Portland across the United States. I mean, I spoke to somebody in Portland yesterday morning who said to me that he thought that the protesters were beginning to lose the battle and the pendulum was swinging back towards Trump, whereas at the very beginning, of course, it was exactly the opposite way. So I think it's an incredibly difficult situation to read right now on a political landscape, Sean.
Well, it is an I mean, when you look at inside the Republican narrative, whether you buy it on the surface of it, but nonetheless, it is bringing forward the idea that the question about are we giving away too much free money and will that have an economic negative impact rather than positive? Is that credible, do you think, James, or is that just some kind of smokescreen for some other political point scoring?
You know, I think it's a classic political argument, isn't it? Where you know, if you can push the problem 4 years down the track, it's not a problem. You give it to somebody else, or indeed give it to your own new administration to deal with, and then you kick that can even further down the road. I think because the whole world is in this game right now, it's a no impact sort of environment. You know, we are all used to as business people that somebody ultimately has to pay the piper, or, you know, different analogy, don't be the person holding the parcel when the music stops. But everybody is in this game. And because everybody's in this game, you know, I actually think the reality is that we won't see the kind of impacts that we would have expected from this kind of financial stimulus if it was in one place alone, where ultimately somebody has to pay for that. I think for me, the bit that hasn't really come out yet, and I think will come out, if I can just shift across to Europe for a second, Sean, is the fact that the details around the European stimulus, you know, I really do feel that there's a very significant element in the middle of that, which is this is more money being provided to some of the European economies that have no means of paying back their first lot of economic stimulus during the economic downturn. So we'll give you a bit more liquidity to pay back the sort of like the interest on the loans that you had before, plus a bit of, you know, with the United Kingdom out of the European Union, you know, we can't have any guarantee on that.
In all of this sort of 4 or 5 month narrative, I don't think we've even got to yet the whole default scenario. We've had a few bankruptcies and so on, but the bank lending default wave, I think, is still to come. But Kevin, one of the places where they can't print money, and I'm sure they wish they could, is the oil majors who are going to be reporting in the next week. And the outlook for them is pretty grim. What's your view, and where do you think they go with dividends?
Yeah, as you say, I mean, the reporting cycle starts, I think, on Thursday. and goes through until the start of August with BP coming in at the end. We've already seen them sort of preparing the markets and preparing investors for significant write-downs in Q2. Where the markets are, where the oil markets are, the products markets are, refining margins are, and where flat price crude is, I just don't see how that can be a bullish scenario going into the third quarter. I think we're going to see some very bleak results, and I think we're going to see continued write-downs. I don't see how. I just don't see, given this sort of second wave that seems to be popping up, as Vandana said, around different parts of this region, different parts of the world, that economic recovery that we were all hoping for, towards July and into August, is probably going to be deferred at least. And on that basis, I think it's a relatively bearish outlook for the oil majors.
We saw Shell being a bit of an outlier in the second quarter, or from the first or second quarter results, the first quarter results, that they curtailed their ancient dividends in which pension funds rely. Do you expect more companies to be following that trend on this occasion?
I think that set the precedent for the others to do so. I'm a former BP employee myself from about 10 or so years ago, and I still have some BP shares, and I look at them, and in real terms, and even in actual terms, they've hardly moved in 10 years. So the only reason you keep those is because of the 6 and 7% dividends that you get. Now, as an investor, when those dividends start to drop, you start to really question why you would continue to hold them. And I think that the precedent set by Shell allows the other majors to probably cut their dividends to a similar extent. And as a result, it's, again,
it could be a transformational moment. Without dividends, why am I holding shares, said the pension fund of school teachers from San Francisco.
Yeah, the dividends effectively replace the underlying growth. So if you accept that as a premise, then that's okay. But if the dividends disappear, then why are you holding it? Why are you holding the share?
And another development we have in the digest today, I think it's an interesting sort of analogy for where this argument goes vis-a-vis market share. U.S. oil exports to Europe cutting into OPEC market share, and that they had a pretty big number, about 30 million barrels in July, or in June rather. That indicates, where does OPEC go when they see these other producers coming back and taking their market share? Indeed, I think these are precisely the kind of numbers that OPEC will be keeping a hawk eye on. As market demand returns gradually, who is the first mover? Who grabs that? Is it the shale producers in the US, or is it the additional 2 million barrels per day that OPEC and its partners are allowing themselves? Look, China is not buying much of US crude, so and if they are starting to bring back some of the oil, as we know they are, especially the shut-in wells, we know there isn't much demand for that at home, hardly any, so they have to look for the export markets. I feel one of the reasons that OPEC Plus did decide to go ahead with tapering the cuts was precisely this, that they wouldn't want to lose any of the market share as the demand returns to their
even at the risk of the price getting dampened down by the increased supply.
Oh yeah, I think so. And in fact, if anything, I think the clever OPEC Plus strategy would be to try and keep TI around 40, 45, not let it go back up to 50, at which point it could revive shale growth.
James, you've been a pretty harsh critic of the view that shale would struggle to recover. Do you still hold that posture? There does seem to be some barrels coming back out of US and Canada.
Yeah, I think there's a couple of points with regards to shale which are relevant. I'm going to come back, if I may, to Kevin in a second with a little question for him on BP. But yes, I remain in that position. As long as price stays where it is right now, I think the shale oil story will be, and probably correctly, a mix of the best low-cost producers, which it should be, and secondly, just how much the United States will be prepared to underpin and financially support for energy stability and energy security. And once that balance is found, and whether that balance is sort of 10 million barrels a day or 11 or 9, that's probably where it will stay as oil realistically stays in a sort of a 30 to 60 window. And the reason for that is simply because the financial security to invest in that shale oil production and back those companies is not going to be there from the financial community. Now, if I'd like to come back on to Kevin on the fact ex-BP, I accept the point around the oil majors around why would you invest in BP or Shell or whatever if they're actually dropping their dividends. But if you're a seasoned investor, there's also the second aspect of why are you investing in energy stocks? And if we go back over the course of the last decade, one of the things which has spooked investors is the companies not having clear strategies about what they are. And in fact, on occasion, that was enough to drive Shell back away from renewables, like the London Array project, where they were the early entrant investor, and say, look, we're not in renewables. We're not in that space. We're an upstream, downstream oil and gas company. Now, in the course of the last year, we have seen a wholesale move away from that for Shell. We've seen a wholesale move away from downstream products as BP have sold to Ineos. So my question for Kevin and indeed Vandana is, if you are an energy investor, how much does the strategy of the super major play into your thoughts now? Not just whether or not they're paying a dividend, how much does strategy play into your thoughts?
Kevin, you want to
I
grab
have
that?
a quick answer for that.
Go ahead.
Yes. So I talked to quite a few in the wealth management community. And as Kevin was alluding to it, it's called the lost decade, basically, in oil, the past 10 years. And increasingly, this community is now looking at the fact that prices are going to be lower for longer and forever, probably. And oil is going to get replaced perhaps even faster by other fuels, other sources of energy. So, I highly doubt the enthusiasm, the interest for investing in oil will really pick up from this point onwards. I think it's probably going to plateau or continue going down.
Kevin, your thoughts on that? I mean, personally, I think Bernard Looney is a man I'd invest in just because I think he's got vision for a new energy future.
Yeah, and that's the point that I was going to seize on. That Shell, as James mentioned, Shell lacked a bit of clarity around strategy a couple of years ago and realised that was putting people off. BP have responded to it by replacing Dudley with Bernard Looney, who clearly has a vision, whether it's renewables, whether it's a zero carbon or a net zero carbon future, etc., and the steps that will be taken along that route. I think that's what investors are looking for, and there was a shortage of that, right? So yeah, the dividend keeps you happy for a while, whilst everything else is sort of a little bit unclear. But if the dividend disappears and you've got no strategy, then you've got a problem. I think it's very unfortunate timing for BP and for Shell and for other majors that, when they've come out with these new strategies towards the middle of last year and into the start of this year, they suddenly face the very strong headwind of COVID. And that's obviously not helped with the bedding in of new strategies and not just bedding in, but also the sort of the socializing of those new strategies, working out what's actually going to be good for the company and good for the investor. But I think ultimately, yeah, we need the dividend or else we go back into the lost decade. And we need the strategy to convince us to stick with it, to keep the faith.
And I think I would be of the view that they probably need much more transformational leadership. The last Puyan is a pretty innovative guy, but the others tend to be, very downstream, very kind of micro managers rather than visionary. It seems Looney, coming from the upstream, has brought that kind of ideas back to the forefront that would seem positive. That's kind of my own 2 pennies worth. But let's bring up the survey question of today before we go around the panel for their views for the rest of the week. The survey question is addressing this issue of the majors. Do you expect most oil majors to slash Q2 dividends in a way that Shell was the outlier in the first quarter? What are your views? More dividend cuts, yes or no? James, let's kick off the final section with you answering your own question. You're obviously an investor. Do you buy into strategy or dividend?
Yeah, so for me, I almost always lead with strategy. Clearly, dividend is a nice plus to have, but it's not where I take my leading position from. And I think, back to the question, the original question which you asked me around shale oil, there's also an aspect here around US oil companies versus European oil companies. At the present moment in time, it's very clear that the European majors are leading the charge in terms of the energy transition. And the US majors are actually choosing not to follow that path. I do think they will ultimately follow, because I think they have to. Andy Levin on the chat room, makes a very good point, which is that one of the challenges that the majors will face is that there's a whole plethora of new emerging energy companies, not all of them in the upstream sector, who are able to come to that place, that transition story, with a clean sheet of paper. And that is right. And as you know, I frequently poke that sleeping bear with a stick of, why would we rule out energy or Amazon energy as on to refer. The clear thing for me is it's around strategy. I'm looking at the Totals, the BPs, the Shells at the moment. Obviously Equinor, although they have a get out of jail card by being backed by the Norwegian government. But all of those companies are putting some major thought leadership into the energy sector. And looking at our lost decade, I think I have to look to that. Look to, as you said, thought leadership, and where's it going and who's taking us there.
Vanda, your closing comments, outlook for the rest of the week. I'd just draw everybody's attention to Vanda insights that are posted on the Daily News Digest.
Thanks, Sean. So I think fundamentally the markets are probably leaning towards a bit of an oversupply. It's very clear from the structure of TI Brent, the contango has been widening. I think the US dollar is and will remain very firmly in the driver's seat. Belt up, I think, for a very wild ride on the dollar, on gold, just generally financial factors that will be in the driver's seat. And of course, we have the US weekly data that will be coming up. I think the expectations are for a moderate drop in crude and gasoline inventories. I would say that should be a supportive factor, but back to the dollar, I think that's what will determine where crude goes next.
Before we get the last word from Kevin, let's bring the survey result up if we have it and see where the room's view is on whether the majors will be, yes, you wouldn't have got that 6 months ago, would you? Do you expect most oil majors to slash dividends? Yes, by a whopping 85%. Run for the exits, pension funds. Kevin, your closing comments, and particularly on that last point Vandana made, outlook for inventories this week.
Yeah, as you know, my company looks at inventories on a continuous basis, on a constant basis.
On an hourly basis.
Pretty much.
And you guys do a great job. I think everybody would agree. Kpler are really the rising star of that space. So go on.
Oh, that's very kind of you to say. Thank you, Sean. But coming back to the point, I mean, Chinese inventories are still up around 890 million barrels. They've been there for a few weeks. Floating storage around the world on crude has started to rise again because we've started to see a bit of structure in the front of the Brent curve in particular. If you look across the products, we've still got a lot of fuel oil being stored on vessels. Asia, for example, just around Singapore, huge amount of low sulfur fuel oil. So all of these things are just weighing on sentiment, weighing on the front of the market, and that's going to perpetuate that weakness that we're seeing. I'm not saying we're dropping into the 30s on the back of it, in terms of Brent flat price, but I think it means that we stay within the range that we are for now, as Vandana said.
Well, it'll be interesting to see what it feels like when all of this new oil comes onto the market next month, with whether we get more recovery out of non-OPEC plus, but also the OPEC plus barrels, million or to 2 million coming into the market. James, I can't close this session without getting your views on what I think is a somewhat sort of serious story in perhaps Barbados offering remote workers 12-month visas and no tax with renewable after 12 months. If we're all going back into lockdown and remote working, why not go to Barbados? I kind of think it's a good idea.
Yeah, why not? I think it doesn't have to be Barbados. I think what Barbados is picking up on is the fact that we are now entering a phase where people will choose to work in the way they wish to work, in the place they want to work, and with the companies that are open and flexible enough to allow them to do that. And, look, I don't see a wholesale move of technical resource towards Barbados, but the reality is I do see a wholesale move of our technical workforce back into a place that they feel very comfortable with. That might be their holiday home in Spain or Ireland or France or whatever it might be in the shed at the bottom of the garden.
Yeah, it's certainly, I think, an interesting thing to what are the new trends to work that will last through this legacy period. I don't think it's an insignificant part of the offer. Of course, that Barbados is offering tax-free on your income, so that certainly adds to the incentive. But let's close it out there. Mike Muller commenting on the chat line, great place to work, but accommodation in Barbados is not cheap. That's true, but if you're not paying tax, it probably compensates a little bit. Okay, well, let's see where inventories go today and tomorrow. That could send a direction on the market for the rest of the week. Thank you, Vandana. Thank you, James. Thank you, Kevin, for your insights this morning. Everybody have a safe day and an economically productive one. Thank you so much.